Okay, so yeah, we understand the rationale and why it's a win-win. It makes sense that given that the credit union is going to effectively spend money to retain the employee, that this is one vehicle through which they would do it. But as you alluded to, can you sketch out what are the downsides of doing this from both the credit union's perspective and the employee's perspective? And here, folks, we'll just lightly touch on it and give a hint as to what the LifeNotes program does to solve these problems, or if you prefer, to make the split dollar approach even better than it originally was. And then we're going to turn to Steve because he's got his own personal story of just this in action. But maybe, Jay, just to kind of set the table, just real briefly, high-level overview, what are the downsides from the credit union and the employee's perspective, even though the split dollar plan does have a lot of attractive features?
Yeah, of course. It's a great question. So a collateral assignment split dollar plan has a few things that certainly right now would be considered downsides. First and foremost, the duration of this loan. It's a very long-term loan. The opportunity cost is very high.
Welcome to InFi, the future of finance.
Hey, everybody. Welcome back to the InFi podcast. Today, I am going to be speaking with two members of the Infineo team, specifically Jay Rogers, who's our Chief Revenue Officer, and Steve Baillargeon, who is a VP of Support Services. What we're talking about is the LifeNotes program. So this is something that was administered by Capaxa, an entity with which Infineo merged formally in December of 2024. And as we'll explain in this discussion, LifeNotes offers a solution for institutional holders of life insurance assets. Specifically, what we talk about in this episode is how an institution that's sitting on a CASD split dollar life insurance plan that it designed for employee retention purposes, how both the institution and the executive employee can benefit from participating in the LifeNotes program. So if you're intrigued by that, I encourage you to listen. It's an extremely impressive idea that was invented by Eric Stearns, and we talk about it in this discussion. If you want to see more about the LifeNotes program, you can go to lifenotes.info. And of course, we'll have that link and others if you go to the show notes page for this, which is InFi episode 88. Without further ado, here is my discussion with Jay and Steve. Gentlemen, welcome to the InFi podcast.
Thank you. Great to be here.
Thank you.
So I would have already given folks a little bit of a teaser in the pre-recorded introduction, but just to make sure everyone understands why it is that we want to be listening to all the insights you guys have to offer, can you just give brief bios and explain, how it is that you're now here talking to me on the InFi podcast? So maybe Jay, we'll start with you.
Yeah, of course. And it's great to be here. My background coming out of college in 2010 in the Boston area, went right into the financial planning and life insurance business. I was at New York Life for 5 years as an advisor and as a partner, managing a team of advisors. And then I moved into Mass Mutual in downtown Boston, a group called Commonwealth Financial Group, where I was a part of a firm in Boston focusing on life insurance as well. And it was there that I met Eric Stearns, and we started to build out different divisions within Stearns Financial Group, a legacy family business that's worked with credit unions for several decades. So over the last decade of working with the Stearns Financial Group and the last few years of launching LifeNotes, we've really become more of an innovator and product developer in this space. So that's my background in a quick high level.
Okay, and Steve, do you want to just give us a brief snapshot of your background?
Sure. Thank you for having us on the podcast. Appreciate that. So my entrance into the credit union space actually began working at CUNA Mutual Group, which is now called TrueStage. And I actually was an account rep that focused my territory was in New England. And in the process of working for them for several years, I ended up with a bonding claim. So I worked the bonding claim at the credit union, and I ended up spending so much time with the board of directors. While I was doing that, they offered me a position to be their new CEO. And I did that. That was a very long time ago. And I actually was their CEO for 19 years. And I retired 5 years ago from doing that. And my introduction into Stearns actually came as I was trying to figure out what to do about my split dollar that I had. And I ran into Jay and the Stearns family.
Okay, great. And so we'll launch right into it then. Jay, can you maybe first, just for the benefit of people who they may know the term, but they might not understand the mechanics, what would it mean to say that a credit union has a split dollar plan with an executive? Like, why would they go ahead and do that? What are the benefits and purposes of such an approach? Just to,
Yeah, great
set the
question.
stage.
Great question. It's probably best to start from the beginning, right? So credit unions have been innovators in leveraging different tools to retain their top level talent, their key people. As Steve said, Steve was one of those key people at one of those institutions. And, for a long time, they leveraged products that sit on the balance sheet as liabilities and accruing against those liabilities. And several decades ago, a product called collateral assignment split dollar was introduced to the credit union marketplace, where credit unions would leverage opportunity cost on the balance sheet as opposed to expense or accounting cost. And they would do so by making a very low yield loan to the executive, typically anywhere from 0 to 2%. And they would make that loan to the executive. That executive would take that capital and purchase a very large life insurance product that was designed to do two things in particular. First and foremost, it's designed to pay back the credit union the loan plus the low yield compounding interest at their death. And secondarily, it was designed to pay that executive a distribution or a benefit in retirement. And typically that's structured as 20 years of that benefit. And then any overage in that asset would get paid out to that executive's beneficiaries upon their death. And one of the key features of that tool is the product is actually a non-taxable benefit, because that distribution is paid out via a loan against their future death benefits. So it's not even considered income. And so it's a really attractive tool if you can put one in place at a credit union for an executive. It's an effective retention vehicle.
Okay, it's going to be critical for the listeners to get how this works. So again, your point is that the credit union, they want to offer a variety of incentives for the executive to stay and working for them. So of course they pay them a salary and things like that. But in addition, they take a bunch of money up front. They effectively loan it to the executive, who then uses it to buy a high premium life insurance policy. And so you're saying that from the executive's point of view, that's not treated the same as taxable income, because, hey, it's just a loan.
Exactly.
But then, of course, the executive gets a lot of benefits from that policy now being in place. But for the credit union's perspective, they know they're eventually getting their principal back plus some, a modest amount of interest, as you say, like maybe 2% or something annualized, because they effectively have like a lien against that life insurance policy, that when the death occurs and it pays out the death benefit, the credit union at that point gets paid back its original loan amount plus the accrued interest along the way.
Exactly. Yep. And it's a very unique tool, but it brings together what these institutions do best. We always say, credit unions are in the business of lending money. And so this is just an extension of that, right? They're able to retain their key talent by lending money. And yes, the benefit is created partially by that loan being at an exorbitantly low rate over a very long period of time. And so that right there is what has created the opportunity that we're taking advantage of through the LifeNotes Trust. But in its inception, collateral assignment split dollar is, again, a loan from the institution to try to compete with some of those other parties that are putting in place, attractive retention packages such as banks and other for-profit entities. This is a way for them to get creative and retain a Steve Baillargeon, right, as opposed to him leaving and going to a bank down the street.
Okay, so yeah, we understand the rationale and why it's a win-win. It makes sense that given that the credit union is going to effectively spend money to retain the employee, that this is one vehicle through which they would do it. But as you alluded to, can you sketch out what are the downsides of doing this from both the credit union's perspective and the employee's perspective? And here, folks, we'll just lightly touch on it and give a hint as to what the LifeNotes program does to solve these problems, or if you prefer, to make the split dollar approach even better than it originally was. And then we're going to turn to Steve because he's got his own personal story of just this in action. But maybe, Jay, just to kind of set the table, just real briefly, high-level overview, what are the downsides from the credit union and the employee's perspective, even though the split dollar plan does have a lot of attractive features?
Yeah, of course. It's a great question. So a collateral assignment split dollar plan has a few things that certainly right now would be considered downsides. First and foremost, the duration of this loan. It's a very long-term loan. The opportunity cost is very high. And what I would say is when a lot of these plans were put in place in the 2010s, when interest rates were extremely low, it was hard to envision the opportunity cost getting to where it is right now. When your overnights are kicking out a few basis points, and this is something you could put your capital into to generate 2%, it's not that painful. But when you're able to get 4 or 5% anywhere you go, that 0 to 2% becomes a much greater pain point. So the opportunity cost of what you could do with these dollars and the members seeing what you could do with these dollars and understanding that this isn't a loan that has no defined end in sight, that's considered a major down point.
Okay, again, just forgive me, but I just want to make
Yeah.
sure we're not losing the listeners up front here. So again, you're talking about from the credit union's perspective, they're advancing this pile of money on the front end that's going to be used to pay the premiums. Maybe it's like a 10-pay policy or something over time for the executive's life insurance policy. And the credit union now has a note that guarantees that the principal repayment plus a modest 0 to 2% return, which, as you're saying, in the 2013, that wasn't such a bad deal. Now that rate of return isn't very attractive. But on top of that, they don't even know exactly when they're getting paid back, because they get paid back when the death occurs on the insured.
Yeah.
And then out of the death benefit check that the carrier sends, the credit union gets paid back plus interest. And so it's a double whammy of a modest return and an uncertain date of redemption.
Absolutely. Yeah, there's over $1 billion worth of split dollar loans on the balance sheets at credit unions that are on people who are no longer employed at the credit union. We tell people out there, this is a pretty large marketplace. There's over $9 billion of these split dollar loans out there, right? So it's a lot of capital that's out there. And we don't know when they're going to get paid back. And so that does create a major pain point.
Okay.
Not to mention, what I was saying a second ago is a lot of this capital is out there and it's not even actively retaining somebody in this very moment. That person's either retired or they left to go to another opportunity. So that's probably the biggest downside of these tools is the opportunity cost, the lack of clarity around duration, and the impact on the balance sheet to the credit union.
Okay. And then now just real briefly so that's showing, why from the credit union's perspective, as you say, particularly if the executive for whom this plan was developed, retires or goes to another company or something, that they're stuck with this asset that in many respects isn't so attractive. And then just real briefly from the executive side, even though we do understand, oh yes, the benefits of you get this plan where the upfront funding is not treated directly as taxable income the same way as if they just got a bonus or something. But yeah, there are some downsides as well. So can you just real briefly explain from the executive's point of view?
Yeah, the major downside with these assets for the executive, there's a lot of positives, but the major downside is they are bearing 100% of the risk of performance, right? So if this product underperforms, it's going to completely come from the executive's benefit, right? It's not going to eat into the credit union's loan plus compounding interest. It's going to decrease the executive's benefit in retirement. And they know that going in, but still, as we saw in the 2010s, we saw a number of blue chip mutual companies have to decrease their dividend. And that had a major impact on these plans. Even a 10, 20 basis point decrease in dividend, when you have the drag of the loan to the credit union, the drag of the future loan against your asset, and now you're decreasing the dividend, that can have a major impact. So we saw a number of executives whose plans underperformed from what they were told or what it was projecting when they originally put these plans in place. And that's for whole life insurance. When you get to a number of plans that were put in place using IUL products, look, IUL products have their place in the marketplace, and they
which stands for Index Universal Life, just to make sure we're going to
Index Universal Life. They do have a good place in this market. And there's well over $1 billion worth of IUL, multiple billions of IUL product out there on split dollar loans. But the same thing goes for those products, and even then some, because if the index product underperforms, it's going to have a dramatic impact on that asset, especially if you're using that asset for living benefit and not for the death benefit repayment.
Okay, great. And again, just to spell it out to be crystal clear for the listeners. So the idea is this isn't a term life insurance policy where, just when the person dies, boom, there's a big pile of money that comes in. It's a cash value product, either whole life or some version of UL, perhaps indexed to the stock market or something. And so the idea is, as you're saying, that the executive, when they're in retirement years, for example, the illustration at the initiation of the split dollar plan, they might have shown, well, hey, if the dividend rates paid by the carrier continue the way they've been doing historically, when you turn 65, you could start drawing, a certain amount per year. And effectively what would be happening is either you're borrowing a loan against the policy that the carrier's paying, or, you're like, quote, withdrawing from the policy's cash value component, but it's sort of drawing down against the policy. But they can't take too much out because there has to be enough left in the kitty to pay back the credit union,
Correct.
the principal plus
Yeah.
the, so you're kind of
touching
hemmed
on
in
a
there.
great- you're touching on a great point, Bob, in terms of one of the perceived negatives is the ongoing relationship that's required between the credit union and the executive in retirement, because every year that executive has to reach out to the credit union and ask for their benefit. The credit union then has to reach out to their vendor and ask for an analysis to make sure the plan can sustain that benefit. Assuming that it can, they then request the distribution from the insurance company, and it takes a period of time there. If the plan has underperformed, they're going to have to go back to the executive and deliver some bad news. Hey, it may look like your number of distributions is going to have to come down, or your benefit amount is going to have to drop due to the interest rate and dividend rate environment. That may be something that they have to deal with.
Okay. And so the teaser is what I want to bring Steve in here, Jason, but just to state that the LifeNotes problem, or LifeNotes solution solves these problems, and it allows for both the credit union and the executive to end up with holding an asset that they prefer to what they started out with.
Absolutely. Yeah, the LifeNotes solution really does. We really do believe we've built a better mousetrap that can add a lot of value to these existing contracts and relationships and reduce a lot of the friction that's there, both in the product performance and also in the relationships that are there from the inception of these products.
Okay, great. So maybe now, just because I know Steve's probably feeling lonely over here, Steve, why don't we bring you in and maybe just explain it from your perspective, that you were in the trenches, you were one of these executives with one of these split dollar plans. There were some issues, and then maybe explain how the LifeNotes program solved the problem in your specific case, and then maybe we'll pull back and open it up more generally and explain to the listeners, how can this happen? How can this be? But just from your perspective, like how did you experience this?
Yeah, great. Actually, so when I was with CUNA Mutual Group, I had a pretty good sized territory and was doing quite well. And in order for me to go to work at the credit union, it was agreed with myself on the board that my wages would have been too high for one of that size. So we ended up agreeing to do a deferred compensation plan when we felt that it was financially feasible to do so. So about 3 years after I had taken over as CEO, I had my first plan put in of a CASD plan, a split dollar plan put in place. So that was 2005. And a few years after that, with review of illustrations of annual performance and that sort of thing, it was determined that we needed to supplement it. So I ended up with a smaller second one. So but mine were around for a very, very long time because I was so young when they first came on board. And I was fine with that because I had a 457F also that was specifically designed to be a deferred savings account, essentially for me to pay for my kids' college education. I had a little bit of a problem with that one. The drop dead date on that was 2008. And if anybody in the room actually has lived through 2008 stock market crash, that went all of my kids' education. So that's a bad story. We won't go down that road. So my particular plans basically just bubbled and sifted along through time. And 15 years later, I pulled the trigger and decided to retire. The illustrations looked good. Everything was okay. Every year it was projected to produce what it was supposed to produce. And then 2001 was when I decided to retire. And if everybody remembers that, that's when COVID started. So my plans actually at the time were supposed to produce what was the typical number in order for me to live off from, essentially. But when it came time to pull the trigger, I had about a 30% reduction in the total benefit amount. So that being said, I decided that I would just wait and not take them at retirement and continue to do, something else and, find.
Can I stop you, Steve?
Sure.
What year did you say you retired?
Excuse me, 2020. I'm so sorry. Sorry about that.
Okay.
Yes, 2020.
Gotcha. Okay. And so people say, well, that's why you had a problem with the plan if you retired before you started.
Sorry about that. I missed it a couple of decades.
Okay. So you retired in 2020. And then when you're saying the benefit was like 30% below, what do you mean that compared to what you thought your annual draw in terms of, call it retirement income, the policy could have supported when they ran the numbers again at the time when you were getting ready to start taking it? They realized, oh no, this thing you'll run it dry if you take that much. So only take 70% of what you originally thought. Am I getting the story right?
That's correct. I could have reduced the number of distributions or actually had a reduced amount. That was what it ended up being. Now, that was not contemplated certainly at the time. So I made the decision to just not take it, and in hopes that the ship would ride a little bit with dividends and interest payables within the actual structure of the plan.
Okay. And so then at what point did you learn about the LifeNotes program?
Yeah. So while we were trying to figure out all of that information, one of the agents actually mentioned that they had heard of this thing called LifeNotes. And they said, "Is that something that you would be interested in taking a look at?" And I said, "Sure, I'll look at anything if it would help the situation out." And that's when I got introduced to Jay and the folks at Stearns Financial. And I was very inquisitive, might be the word, trying to figure out this new product that was out there or if it would fit. It almost seemed a little bit too good to be true. And I have to tell you, after a pretty exhaustive review of the materials that was presented, and me bringing along my financial advisor from another bank, actually, we determined that it looked like it was a solid way to go with mine. And the results of that for me it was restoration of my benefit back to the original amount. So they were able to actually reset the clock and put it back that 30% that I had lost. In the process of doing all of that, I ended up thinking that it would be really nice to be able to share this story with the other executives out there, so that they would understand that there is hope if these plans do underperform or don't perform the way they were intended originally, that this new thing called LifeNotes actually was able to really make my life go back to normal, so to speak. And I was able to, the trade-offs that I had to do in order to make that happen were well worth it in my case.
Okay. So specifically, what happened mechanically that you signed over effectively, like your interest in the policy, and then instead LifeNotes was now on the hook that they were going to give you the stream of payments that you originally thought the policy was going to generate?
Yes, that's correct. And as part of the mechanism for me, I had the policy so long that my cash value death benefit was enormous, which was great, except one of my things was, boy, it'd be nice to have this as a living benefit instead of a dying one, because at the point when that happens, I won't be here. So
Right.
After communication with the family, we decided that it was fine to give up some of that death benefit, most of it, and have some retained interest in the policy, obviously, for when I do pass away. But in the interim, that was what actually created the restoration of my benefit, was to reduce that cash value at the end.
Right. Okay. So big picture, with the original CASD structure that you had, this policy, and you had made plans, presumably planning, you had your other assets, and then you mentioned, you sort of made an allusion to the fact that this other thing you had up and running also underperformed relative to your expectations, to say the least. What you thought the stream of retirement income that this policy would kick off for you when it came time, that was not going to be there. And the way the thing worked is, but hey, once you're gone, the credit union is going to get paid back plus their interest, and then whatever's left over is going to go to your heirs. And so what the LifeNotes program allowed for you is, from your component of that particular CASD plan, was you much preferred to have the certainty of those retirement payments, cash flows that you originally had been counting on. And so that was restored. And then you were more flexible on the residual death benefit at the end. Was the LifeNotes program was getting more of that than what would have happened otherwise? Is that a rough summary of the arrangement?
That's a great summary. Yep, that's exactly what happened.
Okay. So Jay, do you maybe want to just comments, more generally, just and make a specific, or generic?
I think it's a great example. It's a great example of what the LifeNotes Trust is. And again, starting with the beginning in mind, I think explaining the just natural inefficiency in traditional split dollar helps to highlight how this opportunity was created, right? So with traditional split dollar, right, you have the two parties. You have the credit union and you have the executive. In this instance, we have Steve, right? And the credit union makes what in all other instances would be perceived as a bad loan, right? A very low yielding loan with a very long duration and no end in sight. That's not a good loan. Once the plan's put in place, it's usually one of the worst assets on the balance sheet. But they did it for the express purpose of retaining something above and beyond that yield that they're booking over time.
Right.
They take that loan and they give it to the executive, or Steve in this case, and Steve, the executive, takes that capital and goes and buys an asset with the express purpose of manipulating that asset to not act in its most efficient form, right? We're acquiring life insurance and we're manipulating it to look like an annuity. And that's a really useful tool. It's a useful idea, and it's a very tax advantaged idea, right? There's a very long-standing history of leveraging these assets to be able to generate non-taxable income. But we realized that if we were able to introduce a long-term investor relationship to this partnership of the credit union and the executive and introduce this third party, we could add efficiency to both sides of this transaction. First and foremost, to the executive, if we can enable the executive to take their benefit not as a loan from the insurance company, but instead as a loan against their policy from the LifeNotes Trust, we create an asset to the trust, right? A loan that we're making that loan to the executive. It's not an expense, it's an asset to us. And we're able to enable that product to act in its most efficient form, to compound, to grow. And the end result is that life insurance policy will be exponentially larger than it would have been had Steve taken loans every year. In this example, millions of dollars of loans against that asset over the course of a long period of time. And so when you can set that up to operate in its most efficient form, it unlocks additional yield that you can pass back through to the investors in the LifeNotes Trust. On the credit union side, we're able to take that and pass through some of that extra yield to decrease that duration, right? To get them out sooner. So what we do is we enable them to determine what they want their yield to be. Let's say that they were booking 1% on that loan. We would say, hey, we can get you out in 15 years or 20 years, and you can continue to book 1%. If you're willing to drop it to 0%, we can get you out usually in as early as 10 years, right? So they can set up a finite structure and they can plan around that asset now because they know exactly when that's going to mature. So they exchange the promissory note and assignments into the trust in exchange for a certificate worth the same dollar amount and a specified yield with a specified duration in the trust. Their asset, that certificate, is backed by full cash collateral inside the trust, and it's backed by a number of blue chip life insurance carriers as opposed to this one policy. So it actually is a more compliant asset on their balance sheet. Does that make...
Yeah, great. Let me just repeat back some of that to you, make sure everyone's absorbing this. So from the executive, big picture is ultimately both the credit union and the executive are going to effectively sign over. We'll be a little bit loose here with the terminology in terms of the actual mechanism, but they're signing over their rights in this CASD plan to the LifeNotes Trust. And in exchange, the LifeNotes Trust is giving various obligations to both the credit union and the executive. And so the LifeNotes Trust is making similar arrangements with lots of different credit union executive pairs all over the place. And so the trust is building up this stockpile of CASD plans. And so from the executive, Steve already explained from his point of view what happens. So that makes sense. And you're saying now the flip side, Jay, from the credit union's perspective, they're starting out with a note that's a certain face value that's yielding 2%, let's say, and probably it'll pay off in 40 years, something like that, but they don't know exactly when. And for people who are puzzled, again, the reason they did this, it's not because it's a good asset or a good investment. It's because it was part of a compensation plan. Just like, hey, I paid my executive $100,000 in salary. And you say, what did I get for it? Well, you got the executive working for you. That's what you got for it, right? So this is like an offshoot of a thing that was there to incentivize the employee to stay at the credit union and work there. But given now that it's sitting there on the books, the point is, can they exchange it for something else? So LifeNotes comes in and says, hey, instead of having this note that yields, has a certain face value and yields, let's say 2% over likely 40 years, but you're not sure exactly when, what if instead, same face value of the note that LifeNotes gives to you now, but it yields 0%, but it matures in 10 years guaranteed. Like you can count on that. And depending on interest rates, that even might have a higher present market value, but even if it doesn't quite, still, they might prefer just getting the money, the face value back at 10 years.
Yeah, exactly. Their goal is to use that capital to the benefit of their membership, right? Very different what we're doing with the credit union versus the executive. So with the credit union, we're actually acquiring those assets. We're buying those assets from them. They're selling them to us. Executive, it's very important that the executive remain the owner of this life insurance policy. That is how we're able to get them their benefit and for it to still remain non-taxable. And they also are a party who maintains ownership of a portion of the death benefit in this asset. What we're able to do for them is we're enabling them to sell their potential future increases in their death benefit in exchange for more cash now while they're alive, right? So some people, they'll often ask us, hey, what's an example of an executive who wouldn't be a good fit for the LifeNotes Trust? And I always use one example that we have of a client of ours who has an adult special needs child, right? Who's now an adult. And their goal is simply to set up a trust, maximize the death benefit, and take care of their child. And so that's not an example where this would be a good fit, because the LifeNotes Trust's goal is to maximize the death benefit to the trust by enabling this asset to grow unencumbered by loans for distributions. And this executive's main goal is to maximize death benefit to the trust that they have set up for their child. So that's an example. But if your goal is to access this capital while you're alive, the LifeNotes Trust can take you out of the risk-bearing position, provide you a guarantee, and we can give you an increase on the current projection that your plan is currently forecasted to provide you.
Okay, great. So I think we've now established and people understand, why, given that the LifeNotes program can do what it says it's going to do, why it would make sense. Oh yeah, the executive would prefer that and the credit union would. So maybe if we could just spend a little bit more time, because as Steve said, geez, it sounds too good to be true. So maybe just to explain a little bit more under the hood, like, how can you guys do this? So Jay, you already alluded to one element is that, well, because of the pooling mechanism, that one reason that a particular executive's plan might not be living up to what he thought it was going to give him, back at inception time, is that perhaps that carrier is just underperforming, that, the dividends haven't kept up, whatever, maybe they just had some mismanagement or who knows what, but that particular carrier might not be performing well. So through pooling, the fact that now, you're getting a promise from the LifeNotes Trust as the executive here, you're getting these future payments streams where it's backed up by all of these various policies put into the pool. So now you guys have hedged away just the idiosyncratic carrier specific risk, that if one carrier's dividend rates, are relatively low compared to others, that all kind of, gets thrown into the same pool. So that's just one element of how you guys can afford to give the executive a more certain, promise that is more dependable, and that that's a credible promise.
Yeah, I would say the best way to think of it is, above and beyond the fact that we're allowing this asset to act in its most efficient form, we're dramatically increasing the efficiency of administration of these assets. And the best way to think of it is, we're kind of keeping it all in the family here. As opposed to having a credit union making a loan that's drawing interest on that loan, that's accruing against the life insurance asset, that promissory note is acquired by the trust. And the trust is the one charging the rate on that loan now. So that accrual against that asset is flowing to the trust. Then when the executive goes to take their benefit, instead of taking it as a loan from the life insurance carrier and drawing income as a loan from that carrier and charging interest, and the carrier is charging interest against the future death benefit, that executive is taking a loan from the trust against their future death benefit. And again, it's creating this direct relationship with the executive and the trust, as opposed to having multiple tentacles of drag coefficient on that asset. So when we make a guarantee that we're going to pay the executive $100,000 a year in retirement, we know we can back that up, because when they come to us to request that loan, that benefit, it's an asset to us. It's a loan. So we're going to provide that executive with that loan at or below the rate that their insurance company would have been charging them. So we can make these dynamics more efficient inside the trust once these assets are pooled, and in doing so, unlock additional yield in these products.
Great. And then another element too, I think this was implicit in what you just said, but just to tease it out. And so folks, of course, here, I'm an economist who's been studying this stuff too and trying to figure out how this works and reverse engineer it. That Eric Stearns was the genius who kind of cooked this up. But the interesting thing is there's a two-pronged element where, from, again, the LifeNotes Trust is getting these promissory notes that the credit union originally held, certain face value yielding, again, let's for a specific example, say 2%. And then what the trust is issuing to the credit union instead is the same face value, but only yielding, let's say 0%, but it matures in 10 years, call it, instead of likely 40, but we don't know exactly when. And so there is a sense in which for that 10-year strip, the LifeNotes Trust is earning that arbitrage spread.
Yes,
that they're getting the thing. So
absolutely.
there's that element. But then you might say, okay, but wait a minute. But then beyond that, though, right? That now then the LifeNotes Trust is stuck with this 2% yielding thing. And so is it? Yes, but they get that upfront, arbitrage of cash flow, if you will, or arbitrage earnings differential. But then also in the long run, they have all that excess death benefit because that again, as Steve alluded, that's another part of the deal. Like the way in terms of the deal that the LifeNotes Trust will make to the various participants is, they'll just make sure it's that when all is said and done in the long run, there's more death benefit flowing to the trust to cover all these things. And so it's kind of protected on the front end by that spread and in the long run by the excess death benefit. So all the pieces all do kind of fit together. And you can see how it makes more sense. It's more effective when you pool it and scale it. And then everyone's just sort of getting the average but anyway, that's just to give more insight into how the heck does this actually work?
Yep. Yeah, no, it's a good point. There's a number of things that when you pool these assets and you have the ability to just increase that efficiency of administration from the credit union side and from the executive side of these assets, there's a lot to unravel there and a lot of benefit to be exposed. I think the other piece here, which we've not really gotten even into yet, is just where is this going? Where are we taking this? And how can we even further increase the efficiency of administration? And that brings us to the conversation around Stearns Financial Group and LifeNotes Capaxa's relationship with Infineo. So I don't know if this is a good point to talk about that, or if we want to stay and talk more about the LifeNotes product and how that works.
I did want to just circle back and let Steve just comment, because another element in all this is, I don't remember if it was Jay, you said it, or Steve, that the way the traditional CASD arrangement works is the executive would have to keep going back to the credit union. And, you can imagine scenarios where maybe they don't get along anymore. And so there's certain situations too, where just dealing with now, the LifeNotes thing and just kind of separating that and having a clean break, that's just another reason that could be more effective for certain situations. Again, especially like if the executive, has left the company or something, that clearly it would make sense just to kind of centralize this and have all the cash flows and arrangements just going to one centralized entity. Do you want to comment on that, Steve? Or?
Yeah, sure. Absolutely. So in my case, actually, ironically, that is what happened. So when I decided to retire, the credit union made the decision to merge itself into another credit union that did not have split dollar plans. And the go forward for them was very difficult because they didn't have any to have a basic understanding of what the plans were. And once they found out that there was an opportunity to not have to administer those going forward, that was extremely advantageous for them. But it also was advantageous for the 4 executives on my team, myself included, which was our reach out was actually going to be to the trust rather than to the new credit union that we don't even know the people that were working there. So for me, that was extremely advantageous. And the other point that I wanted to make was I do have additional retirement benefits that I had accumulated over time. So in my case, I had a defined benefit plan and I also had the SERP plan. And for me, it was the defined benefit was essentially a guaranteed, benefit that I was going to receive in retirement. And the split dollar plans actually were essentially variable. So I had a nice mix between pretty much guaranteed and variable. Once I retired and the merger occurred, they actually terminated the defined benefit plan. So for me, I now was at market all risk for everything. So the LifeNotes actually solution for me kind of flip-flop stuff because it comes with the guarantee so that I now have guaranteed money, kind of like my defined benefit plan was going to pay out. And then my defined benefit plan turned into a market-driven one. So that was the variable nature. So they kind of cross paths. Who would have ever thought that would happen? Nobody. But for me, that worked out perfectly. And the other 3 execs are extremely happy as well. So overall, good stuff.
Okay, well, great. So yeah, Jay, if you want to now talk, we sort of explained the basics of it. Also, folks, just so you know, there is a way that Keoli plans, credit union-owned life insurance, also play a role in the LifeNotes Trust, but we just decided that would be biting off more than we can chew in this one episode. So we're focusing here on the CASD element. But having said all that, Jay, what's your vision for the future and how do you see this now even becoming more dynamic?
Yeah, I think for the benefit of the listeners, you make a really good point there, Bob. So let me say one thing about that last piece you touched on. When we brought this product to market, we had a number of banks and family offices ready to fill that investor side of what we're discussing here. So the third-party investor that's introduced to this relationship, we had a number of family offices and banks ready to fill that. But we decided before moving forward with that to go back to our credit unions and see if they would be interested in filling the investor role in this relationship. And to date, we have only taken money from credit unions. And we've had credit unions invest in this product in two ways. They've invested in the LifeNotes Trust by investing cash, but more commonly than that, they've invested by transacting their QOLI portfolio into the trust in exchange for an investor certificate in the trust that gives them an increase on their yield. Typically, it's a dramatic increase. Usually, they're taking a 15-year certificate with a yield of SOFR 30 plus 270 basis points, which is right around 7% currently. They also receive a securitized spread certificate, which gives them future interest in the cumulative excess death benefit inside the trust. So it's an important factor, right, to understand that who owns the LifeNotes Trust? It's not me. It's not Steve. It's the investors, the certificate holders in the trust who own the LifeNotes Trust. And so that's a key component there. I'm sure that another time we can dive deeper into how that works. But moving forward, it's always been a plan at Stearns Financial Group and Capaxa that the LifeNotes Trust would take on a fintech element and expanding into how do we improve upon the administration. And we believe strongly that a key component to this is leveraging blockchain technology and artificial intelligence, AI, in administering these assets, in educating around these assets. But obviously what we've just spent the last 30, 40 minutes discussing is a complex relationship, manipulating products and adding complexity to them, right? We're not just talking about a life insurance product. We're not just talking about a loan. We're talking about collateral assignments. We're talking about liens. We're talking about distributions and multiple loan relationships. And we believe strongly that blockchain is going to dramatically simplify these relationships. It's going to add transparency, dramatic increase in transparency. It's going to add clarity around regulation. It's going to add clarity around audit. And it's going to add comfortability to the parties who are involved in these transactions, right? When I have somebody like Steve who comes to the LifeNotes Trust wanting to sell or assign parts of their asset to the trust, instead of necessarily just needing to bring in a financial advisor, we can just provide them with the permanent record and blockchain records of what are the assets, where are the assets, what has happened to the assets. And that's why we, over the course of the last year, have looked to bring on Doran Mayhew as the auditor of the LifeNotes Trust, specifically because Doran Mayhew is the largest auditor of credit unions across the country, and there's a great deal of trust in their firm and in their work. And we believe that blockchain technology and the implementation of that technology within the trust will make their job easier, and it will just add great levels of transparency to what's happening inside the trust.
Well, great. Yeah. And as I've explained to people in terms of, infineo merging with what you guys were doing, that there was a sense in which infineo, we had been building the tech in order to the blockchain to be able to take life insurance and put it on the blockchain. So we were getting all the tech built, and then we were getting ready. Okay, we spent 2 or 3 years doing that, building the tech. Now let's go find some life insurance. And you guys almost did the exact opposite, where you first accumulated this huge pool of life insurance assets. And then you said, okay, now that we got the assets, let's start building the tech. And then we found each other, and we sort of effectively saved each other, 3 years of time, as it were. And and I agree. Again, folks, as you can gather, the trust, even though conceptually, when you break it down, it makes sense, in practice, to implement it, you got to be careful. Like the numbers have to match, and like you have to have the right balance of QOLI with CASD and so forth. And you can see how all that matters, that the cash flows on the front end have to correspond to the, enough excess death benefit and so on. And so just breaking everything down, as Jay was saying, having AI in the background, helping with the computations and just keeping track of all that we can just press a button, just evaluate and see, what are the total obligations right now, because there's lots of different people who have different claims on various elements of that pool of life insurance assets. And so just keeping track of all that in terms of the accounting and whatnot is a daunting process. And so that's what we're automating as we speak. Steve, I know that not only are you a LifeNotes customer, but now you're out there in the trenches. So can you maybe just speak a little bit about why you were so, I know you alluded to this a little bit, but just to make sure that the listeners understand that you are now on the team as well?
Yeah. So one of the things that I tried to do was retire a couple of times. It didn't work. So in the process of vetting the LifeNotes solution, I actually became very intrigued by what was going to be happening in the future. And we worked it out so that I went on board actually at Stearns in operations as the chief operating officer and essentially helped start the build of the team internally for us to prep for stage 2, which was the automation portion. So that was pre-infineo. And then once we found each other, that the needs of the business changed significantly. And at this point, the VP of our support services team, which is experiencing massive growth in order to handle all of the new programs that have been put in play. And I'm in the process of putting together our give back strategy through .org technology and offerings.
Well, okay. I guess, Jay, do you have any final thoughts for the listeners before we sign off here?
It's just an example of when you can add efficiency to legacy products, there's great opportunity that's there. And you referenced Eric Stearns, my business partner in this venture, and now one of the major partners with Infineo. His genius was really just unlocking some of that captured product and yield that was inside these products already. And so we're excited about where this is going. We're excited about our ability to pass through the value back to the credit unions. And in doing so, enabling credit unions to pass that value back to their membership. And so there's a lot more to come with what we're building. And I think that the relationship with Infineo and the technology we're developing is only compounding that value proposition.
Well, very well said. So folks, if you want to learn more about what we're doing here, just go to infineo.ai. You'll be able to contact us and we can have further conversations on any of these matters. In the meantime, thank you. My guest has been Jay Rogers and Steve Baillargeon. So gentlemen, thanks for everything you've been doing and your time here today.
Thank you. It's great to be
here. Thank you very much.
And thanks everybody for tuning in. We'll see you next time.